we have talked about the impairment of PP&E. Now let's look at the disposition and the exchange of PP&E. First, let's look at the disposition of PP&E. So sometimes after using a non-lived asset for a while, companies may sell or retire those assets. And there are two questions here. So the first question is how to account for the disposition of non-lived assets. And then sometimes firms may not have disposed the asset yet, but they do have an intention to dispose the asset. And that is called the asset held for sale. So the second question is how to account for non-lived assets that are held for sale. The disposition of non-lived assets. So let's first look at an example. Company A sold a patent and the equipment to Company B for $850 and $300 respectively. The book value of the patent and the equipment on the date of sale were $150 and $400. So this $400 is the cost of the equipment is $500 less a cumulative depreciation of $100. So that's the book value, how we get the book value $400. What are Company A's journal entries to record the sale of the patent and the equipment? So please take 1 minute. First, try to write out a journal entry by yourself first, and you can pause your video for now. So what is Company A's journal entry here? Company A's journal entry, so Company A sold the patent for $850. So Company A gets cash, $850, and the book value of the patent is $150. So credit patent. So write off the patent completely from its book because the patent has been sold. And the difference here is $700. And this $700 is gain on disposal of patent. So this is regarding the patent. And regarding the equipment, the Company A gets $300. So we debit cash $300. And then the book value of the equipment is $400, which is cost $500. So we credit equipment. We need to write off the equipment completely from its book, and the equipment has cost of $500, a cumulative depreciation of $100. So, and then the difference between the book value of $400 and what Company A gets $300, that's $100, and that is a loss for the firm. So that is loss disposal of equipment. So those are the two journal entries. And the general rule here is either the gain or loss on disposal of the assets. It is the difference between the amount of consideration received, so however much the company received from disposing the asset, minus the book value of the asset. Amount of consideration received minus the book value of the asset. So that is the general rule here. So this is about if an asset has already been disposed, However, we mentioned that there's a second situation. Sometimes the asset is considered held for sale. And this held for sale just means that the company has an intention to sell the asset, but it hasn't been sold yet. So to be sold in the future. And in this situation, so the asset hasn't been sold yet, but the company just has an intention to sell it in the future. So in this situation, we report the asset at the lower of the book value or fair value less any cost to sell. So we take whatever is lower. And if the fair value less cost to sell is smaller than the book value, we need to recognize an impairment loss and write down the book value of the asset to the fair value less cost to sell. And assets classified as held for sale are not depreciated or amortized. So this is what we do when a non-lived asset is considered held for sale.